Last time you told me the whole game in one sentence. Buyers of premium need a bigger move than the market expects. Sellers need a smaller one. Today we're the buyers, right?
Today we are the buyers. This is the Betting the Move episode, the long volatility plays. The big payoff, heart-racing ones, and fair warning, the ones with the lowest win rate on an earnings night. I'm Onyx.
And I'm Nova, your stand-in for, I've never done this. Welcome back to Options Decoded. Same stock, Micron, same earnings night. Let's go buy a move.
One small thing up front, we genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Quick frame. Everything today shares one DNA. You pay a premium up front, your long volatility, and that means the four crush we talked about is your headwind. To win, the stock has to move more than the roughly 13% the market already priced in, and move fast enough to outrun the crush.
So high reward, but the deck is a little stacked against me.
Honestly, yes. Which is exactly why understanding why matters more than the strategy names. Let's start with the simplest one. The long call, you buy the right to buy the stock at a strike. Our example, a call at the 1040 strike, costs about $57. Times 100 shares, that's $5,700. If you picture the payoff diagram, it's the classic hockey stick, flat loss on the downside, capped at the premium you paid, then it bends upward and rises, in theory without limit.
So my max loss is the whole 5,700, and my upside is open-ended. Where do I actually start making money?
At the break-even, strike plus premium, about 1,097. Notice what that means. The stock has to rise past 1097 just to break even. That's roughly a 5% move before you've made a dime, because you prepaid for the expected move. The hockey stick is pretty, but that break-even is the catch.
And the long put is just the mirror image?
Perfect mirror. The right to sell at a strike, your bet that it falls. Our 1040 put runs about $54, $5,400 all in. The payoff is a hockey stick pointing the other way. You profit as the stock drops, with a break-even down around 986. Same deal. It has to fall meaningfully before you're in the green.
This is where you tell me the heartbreak story again, isn't it?
It deserves repeating with numbers. Say you buy that call, earnings hit, and the stock jumps a solid 3 or 4%. You were right. And you can still lose money, because the 4 crush deflated your premium more than a modest move inflated it. To genuinely win outright on a naked long option here, you typically need a move bigger than the full implied 13%. That's a high bar, and it's why just buying calls into earnings is closer to a lottery ticket than a strategy.
Okay, so what do people do instead if they still lean a direction?
They build a vertical spread, and this is the workhorse of options, so really get this one. A bull call spread. You buy the 1040 call and simultaneously sell a higher one, say the 1140 call. The premium you collect from the one you sell offsets a chunk of what you pay. Net cost drops to about $35, $3,500, instead of $5,700.
What's the catch? Cheaper always has a catch.
Capped upside. Picture the diagram. It's a tent that hits a ceiling. You rise from a lower break-even, around 1075, up to a maximum gain of 6,500 at the higher strike, and then it flatlines. So your max gain is 6,500, your max loss 3,500, both defined and known. You trade the dream of unlimited upside for a much more achievable, cheaper, defined bet. And flip it for down, the bear put spread. Buy the 1040 put, sell the 940 put. Net cost about $38, max gain about $6,250, break even down near 1,003. Same beautiful, boring, defined risk tent, just pointed downward.
I'm starting to like boring and defined.
That instinct will serve you well.
So besides being cheaper, is the spread actually better on earnings night, or just smaller?
Genuinely better in one specific way. The option you sell is also puffed up with that pre-earnings for. So when the crush hits, it deflates your short leg too. And that works in your favor, clawing back some of the volatility you'd otherwise lose. A naked long option eats the full crush. A spread softens it. The price you pay is that ceiling on your gains. For a binary event, a lot of people consider that a very fair trade.
What if I have no idea which way it goes? I just think it'll move big.
Then you stop betting on direction at all, and you bet on size. That's the straddle, by the call, and the put at the same strike. Our 1040 straddle costs about $111, over $11,000, because you're buying both sides. The payoff diagram is a valley, a big V. You lose most in the middle if nothing happens, and you profit out either side if it moves far enough.
And far enough is?
The break-evens sit around 929 and 1151. Translate that, the stock has to move more than about 11% in either direction just to break even. Remember the implied move was 13? So a straddle is a pure, naked bet that the crowd underestimated the move. When it works, it's spectacular. It is not a high percentage bet. If 11 grand makes you wince, there's the strangle. Same idea, but you buy out of the money options, a 940 put and an 1140 call. Now it's only about $39, $3,900. The catch, the break-evens are even wider, around 901 and 1179. So it's cheaper, but it needs an even bigger move to pay off. Cheaper ticket, longer odds.
Everything in options is a trade-off, isn't it?
Every single thing. There is no free lunch, there's only which risk would you like to hold. One more, and this is the cautionary tale of the episode. The combo or synthetic long. You buy the 1040 call and sell the 1040 put. The premiums roughly cancel, so it costs about nothing up front. And it behaves almost exactly like owning 100 shares, a straight diagonal payoff line, dollar for dollar with the stock.
Free exposure that acts like the stock. Where's the landmine?
In that sold put. It gives you undefined downside. If the stock craters, that short put can be assigned. You're forced to buy 100 shares at 1040, no matter how far it's fallen. So a free position can turn into a 5 or 6-figure obligation in one night. The diagram looks innocent, a simple line, but the bottom left of that line just keeps going down. Respect it.
Can we pause on the diagrams? You keep saying picture the shape.
Because the shape is the strategy. 3 to memorize. The hockey stick, a long call or put, flat loss, then open-ended in one direction. The cap tent, a debit spread, defined on both ends. And the valley or V, a straddle or strangle, lose in the middle, win on the wings. Once you can glance at a payoff diagram and see the bet, you barely need the name. The picture tells you the whole story, where you lose, where you win, and how much of each. So let's grade this whole bucket honestly. Everything today calls puts, straddles, strangles is long premium, long volatility. That means 3 things every time. 1. The 4 crush is fighting you. 2. You need a bigger than implied move. 3. As a result, the win rate is lower. You're paying for big, asymmetric payoffs that don't hit often.
So these are the lottery ticket end of the spectrum.
The thoughtful end of it, defined risk spreads especially, but yes, directionally that's the trade-off you're making. Big potential payoff, lower odds, crush working against you.
And the mandatory reality check.
Always worth it. These are genuinely the can lose 100% plays. A naked long option that's wrong, or even right but too small, can go to 0 by Friday. We are walking through these so you understand the machine, even-handedly, not so anyone runs out and feeds it. Education, not advice, and absolutely not a do this.
Okay, so today I learned the buy the move side. Hockey sticks for conviction, cap tends to be smarter and cheaper, the V when I only know it'll be big, and the combo as the thing to be scared of.
Beautifully summarized. And here's the cliffhanger. Every single thing today suffered from the 4 crush. Next episode, we walk to the other side of the table, the strategies that get paid by that exact same crush. Same stock, same night, opposite bet.
Selling the fear. Come back for episode 3. And stick around for the finale, where Micron's real move tells us which of all these actually won. Thanks for learning with us.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world, and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.